Making my own pension with stock dividends? In order to prepare for life after retirement, we have to explore various ways. Among them, dividend investment is positioned as a powerful tool to generate steady returns. Dividends are part of the profits a company distributes to its shareholders. After a company generates revenue, it reinvests a portion of the profit for business expansion or future investment and pays the rest to shareholders in the form of dividends. Dividends are mainly paid quarterly, which serves to provide regular returns to stockholders. Dividend payments can depend on the financial condition and profit margin of a company, and companies that pay high dividends are generally considered stable and mature. Dividend stock investment is an investment strategy that allows you to pursue stability and profitability at the same time. Many investors feel uneasy about the volatility in the stock market, but investing in dividend stocks is a way to reduce that volatility. This is because dividend stocks are likely to remain valued or rise in the long term. In addition, dividend stocks provide us safeguards to offset some of investors' losses through regular dividend returns, even if their shares fall. In particular, when it comes to long-term investments to prepare for retirement, dividend stocks are very advantageous. This is because if you invest in dividend stocks, dividends can be reinvested over time or used as living expenses. For example, if you start investing in dividend stocks in your early 30s and continue to invest for 20 to 30 years, you can generate significant dividend returns at the time of retirement. This will soon be a my own pension to cover the cost of living after retirement. Building a pension from stock dividends requires a long-term perspective. It's not just a short-term investment in buying and selling stocks. It's a strategy of holding stocks consistently for a long time. By doing so, you can continue to receive dividends and maximize your benefits depending on the power of time. The stock market may be volatile in the short term, but it tends to go upward in the long term. Thus, long-term investments allow us to simultaneously pursue stock price increases and dividend returns. When choosing dividend stocks, it is important to choose a stable company. Generally, companies that pay stable dividends for long periods of time are financially healthy and profitable. These companies consistently generate profits despite economic fluctuations and maintain a dividend policy that gives trust to shareholders. In particular, companies that steadily increase dividends, even if their dividend tendencies are not high, are more attractive investment targets. This soon becomes the basis for building pensions through steady dividend income over the long term. A strategy of reinvesting the dividends received rather than simply consuming them makes a big difference in the long run. The dividend reinvestment strategy is a way to increase the number of shares by purchasing additional shares as dividends. This will soon allow you to receive dividends on more stock starting in the next quarter, which will benefit from snowballing dividend earnings over time. This compounding effect is one of the biggest advantages of long-term dividend stock investments, which contributes greatly to the establishment of stable pensions. Distributed investment is also important when investing in dividend stocks. By investing in multiple dividend stocks across different industries and sectors, you can reduce the risk of a particular company's underperformance or a recession in a particular industry. For example, selecting dividend stocks across multiple sectors, including finance, healthcare, consumer goods, and energy, can increase the stability of your portfolio. Distributed investment has the advantage of reducing risk while leveraging the growth potential of various industries. Dividends play a role in offsetting inflation, helping to maintain real purchasing power. Initial investment capital is required to create a meaningful pension with dividend stocks. If you start with less capital, it can take a long time to get enough dividend income. Dividends may decrease or not be paid depending on the performance of the company. Therefore, it is important to choose a company that pays a stable dividend. Creating your own pension from stock dividends is a stable financial strategy that steadily boosts assets in the long run rather than hoping for short-term results. Dividend stocks are an important means of generating stable returns in volatile stock markets, especially for securing lasting returns after retirement. It may require a lot of capital in the beginning, but from a long-term perspective, a steady investment will allow anyone to create enough pensions. Therefore, it would be a very smart choice to start investing in stock dividends from now on to prepare for the future. If you invest in dividend stocks with a thorough analysis and planning of your investment and a long-term perspective, you will enjoy stable economic freedom after retirement. I hope you make your own pension with stock dividends and enjoy a leisurely life after retirement. Please subscribe, notify, and like. It's a great help for me to produce a video. Thank you.